Hey, this is Mascia of Cadwalader. Thanks for tuning in to this week's edition of Fund Finance Friday Industry Conversations. Our email traffic largely fell off a cliff last Friday, so I hope that means a lot of you in the United States were able to take off for the long weekend. I certainly did. I took my family to the beach, and I know you care. I did catch another redfish from my kayak. A lot has happened here in Fund Finance in the last 2 weeks. And we've got a good lineup of contributors today to keep you informed. First of all, Graham Bippart, who's the editor at Private Funds CFO that just wrote this series of articles on subscription facilities, joins to tell us about that process. And then Zach Barnett, the co-founder of Fund Finance Partners, joins to talk about what they're seeing from a fund finance advisory perspective. And then finally, Whitney Namm Pollack, who's the executive director at Project Sunshine, which is a great nonprofit in New York in which Matt Skirby sits on their board of directors, joins to tell us a little bit about Project Sunshine's mission and how the FFA and our individual organizations can get further involved. But before we get started, a couple of material legal updates from the last 2 weeks. First of all, on June 30th, the Alternative Reference Rate Committee published updated recommendations for the language in credit agreements as to LIBOR transition. My partner, Jeff Nagel, and I mentioned before, he represents the ARC as to the LIBOR transition itself, has published a good article summarizing the updated recommendations, which is in FFF for this week. But from a headline perspective, the key changes that going forward, only the hardwired approach and not the amendment approach continues to be recommended by ARC. Additionally, on Tuesday of this week, the Cayman Islands Private Funds Law Amendment was passed. And this amendment changes the definition of private funds to both clarify certain specific entities that are included within the definition, as well as scope in some additional entities that were not previously included. And this is material for fund finance. It's expected that that's going to scope in certain master funds, as well as certain AIVs that were previously thought to be excluded. Of course, these changes get made to scope in new entities, but in their ultimate wisdom, the regulators do not extend the August 7th deadline for which registration with the Cayman Islands Monetary Authority needs to happen by. Nice, right? Next week, we'll have on a Cayman Islands practitioner to discuss the specifics as applied to our documentation and the fund borrower's compliance. But for this week, there are some articles in Fund Finance Friday that some of the Cayman law firms have put out. So with that backdrop, let's get to our visitors. Thanks for joining. Great. So first we have with us today Graham Bippart, who is the editor at Private Funds CFO and has recently spent a lot of time covering the fund finance space. Graham, thanks for joining us.
Thank you very much.
Yeah, I can tell from your background, you're right in the middle of downtown New York.
Indeed, I am. Yes. I'm living in my sister's house right now, and this room is sort of a partially deconstructed bedroom that they haven't quite finished doing the renovations on. So that's the beautiful background, rather than the torn down wall you'd be seeing behind me.
Great. Well, listen, you have covered subscription finance in depth here recently. You started with some articles on NAV facilities earlier in the year. Really want to commend the work you did here on the subscription facility space. You clearly dug in, got to know a lot of the industry participants, and gave a really balanced view of the market. So thank you for that. It's the first time the funds finance market has really seen that. Tell us a little bit about the process, how you got interested in covering fund finance, and what led to the series last week.
Yeah, sure. So the process for me actually began with a phone call I got from a manager at a subscription line lending bank back in late March, after an article I wrote about a couple of capital call defaults that were seen by a London or European-based lawyer. So I spoke with this manager. He told me about the lending dynamic that the bank was seeing, and it became sort of clear to me over the course of that conversation that there was a lot of other stuff going on that I wasn't certainly aware of, being new to this market, but that piqued my interest coming from a debt capital markets reporting background and securitization reporting background. I became just interested in mapping what was to me kind of an obscure market, and understanding as much as I could about how it functions and who the players are, the various structures and underwriting procedures, where various market players operate, who their target audience is, their client base is.
Correct. Well, one of the narratives that ran throughout your series was concern around the availability of supply from the lenders to the borrowers. Was that a pretty consistent message? Was I the only person who wasn't too worried about the availability of supply in the market?
No, it's hard to categorize. I mean, there were certainly other, and it wasn't like it was either, there wasn't like a segment of the market that sort of pertained to one view or the other. It wasn't like there was a borrowers representatives all thought there was a supply gap and lenders representatives of lenders. There wasn't. It was pretty spread across the market. But there, I think I based a lot of that on my conversations with the lenders themselves, and that was where like the sort of the supply, what seemed to be a supply gap sort of came to light. Was that lenders said, like, listen, we've got allocation limits. We hit up against, this is, it's not necessarily the executives' focus right now to be lending out on subscription lines. We've got other credit products we want to use balance sheet for, and also just the idea that maybe this isn't a 500 billion market before, which had been said to me several times. I only quote one person, I think, in the article saying that, but that it had already, the idea that there was some sort of pre-existing condition came up a few times over the course of many conversations.
Anything else interesting you uncovered during this process that you thought was interesting, or that market participants might find curious?
One of the most interesting questions that came up for me during the process of reporting was the extent to which there might be an increase in standardization, both in reporting and in the usage side of subscription credit lines going forward. I think that, as you mentioned in a recent letter for Fund Finance Friday, there are more lenders entering the market, and I think that will create a tendency towards greater diversity of underwriting approaches, potentially a greater optionality for borrowers, and that's great for borrowers, but of course, works against the principle of sort of greater standardization. It's a big market with a lot of different kinds of users, different kinds of uses, but it doesn't really lend itself to being put into a box particularly well. But there are forces working towards standardization. We wrote in one of the articles that Aberdeen Standard Investments, which participates massively in deals as a non-bank player, has seen some banks building out their syndication desks at a sort of what they said was sort of an increased pace. And I think that if an increase in supply, if there is indeed a prolonged need for increased supply, if it comes from the entrance of non-traditional players like ASI potentially, or other insurance companies have been mentioned a few times in my conversations with lenders, potentially get greater participation by them. That standardization, that will create a tendency towards some standardization. So I think all of that will be very interesting to explore. I think we're a long way from probably figuring out what the answer is there, frankly. But
yeah. Great. Well, Graham, thank you so much for joining us today. I look forward to following your articles here in the future. Great. So next we have with us Zach Barnett, my longtime friend and the co-founder and managing principal of Fund Finance Partners. Zach, how you doing?
Hey, Mr. Mascia, I'm great. Thanks for having me on.
You bet. Thanks for joining. How are things in Chicago?
Well, things were great up until about 15 minutes ago when my wife walked down and told me that our daughter's preschool looks like it's going to be canceled. And as you know, Chicago, we're on lockdown due to the weather most of the winter. So just as when the weather started to warm up, COVID descended upon us, and my poor little one has been on lockdown now due to that, and it's just going to break her heart when she can't go to school. So I guess she's just going to be continuing her practice takedown wrestling moves on my 10-month-old son.
Right.
But how's Maria and the girls? You guys getting out fishing at all?
Yeah, we are. We got away for July 4th down to the beach, so it was great. My family's super fortunate. We're doing real well, thanks.
Yeah, I feel bad about complaining. People going through real hardship, and it's silly to complain that we have to make some changes in our lives. So yeah,
for sure. For sure. Well, Graham Bippart was on with us earlier and talked about the series he just wrote on subscription facilities, as well as some of the earlier articles he had wrote on NAB facilities. I wanted to check in with you on that a little bit. You know, one of the narratives in the article was a suggestion that activity levels are coming down. You know, you're talking to a lot of fund sponsors now. How are activity levels from your perspective?
I want to get to activity levels in a second, but first off, I mean, how about Graham? You know, you guys, you and I have been at this for a long time, and, you know, we're immersed in it day to day for, you know, decades now. Graham, I really tip my cap to him. You know, he jumps in, talks to a ton of people. You know, he's the hardest working person in private equity, if you ask me. I don't think we've ever had a reporter become so involved in what we do, and I really tip my cap to him. I think he did a great job. As far as activity levels, you know, I have not seen a dip. I think some of those quotes that Graham had from us were probably in April, which I think was a tough month for a lot of folks in terms of deal activity. I think things are certainly getting better by the day. I suspect that will continue to happen in the near term. I think at some point the lack of new funds being raised will have an impact in what you and I and others do day to day. But I don't see that now. You know, we had more incoming calls from funds, probably, you know, 4 to 5 a week in June, and so far in July it's continuing. So these are new sponsors looking for liquidity, and I think in the short term there's going to be a lot of that.
Yeah, that's pretty consistent with what we saw as well. You know, I had earlier forecasted that I thought our June activity levels were moderating a little bit from the highs in March and April. But as June wrapped up, our actual accruals were really robust. I mean, the moderation was far more modest than I had originally forecasted. It ended up being, you know, a really significant month for us again. So from our perspective, activity levels have really stayed, you know, robust.
What about LPA reviews? That's, you know, a pretty good lead indicator, right? How are those coming?
Yeah, really, really solid. You know, so we track both prospective hours and LPA reviews. You know, we're already, for the first week of July, we've gotten in more LPA reviews, meaningfully more than our rolling 12-month weekly average. So, you know, we're you know, near-term summer type forecasting. We feel really, really good about the third quarter.
What about your long-term?
Longer term, I think, is a little bit more interesting, right? I you know, you and I have chatted before. I do think in this environment, it's going to be harder for first-time and new fund managers to fundraise. And I just feel like at some level that has to impact our deal flow as we move further towards the end of the year. What do you think?
Yeah, you know, I'm becoming fluent in investor relations speak. You know, these are mainly folks that are our clients that are talking to the LPs on a daily basis, figuring out when the best time is to launch their new fund or new fund products. And these are some of the most, as you know, historically positive people in our industry. And, you know, so a lot of times I'll hear, oh yeah, we're going to have a fundraise, we're going to launch in July. Now it may be August. Now it looks, you know, hope in October. And was talking to a woman yesterday at one of our sponsor clients, and she said it's looking like January. So look, that doesn't have to happen at every fund, but, you know, even a certain percentage that happens, that's going to be impacted. That's going to have an impact on us.
Yeah, for sure. So one of the other narratives in Graham's series was concern about the lack of lender supply. Are you seeing particular types of deals where you're having trouble finding banks that are eager to do a deal?
Well, look, you know, I'm always going to want more banks to do deals for our clients. So you got to, you know, I may be biased, but, you know, for the most part, I think that the supply has been there. I think there are a couple pockets that we wish there was more interest. For whatever reason, and you probably have a better idea than I, but banks seem to have shifted their view post-COVID on heavily concentrated investor portfolios. So I don't think anyone can reasonably say that there hasn't been a dip in fund of one subscription facilities. You know, they're just not as many getting done. You know, we have clients with schmosters, AA credit, you know, both large and small funds of one that, you know, we really struggle with. I think it's kind of the perfect storm. You have maybe some of the larger banks that did have an appetite for those kinds of credits that maybe have pulled back a little bit, of course, are re-entering, but there has been some pullback. And then some of the larger banks that have remained more active, you know, really never really liked those kind of credits. So we're having a tougher time placing those, not just funds of one, but even, you know, club deals, 2 or 3 investors, 4 or 5 investors. I wonder, and I kind of want to kick it back to you, curious for your thoughts, you know, why aren't those just priced higher rather than, you know, a lot of banks just really aren't interested in looking at those transactions right now?
Yeah, you had mentioned that to me about 2 weeks ago, and I hadn't really caught on to the trend until you mentioned it, but I did look back, and we are running fewer SMA deals, not none, by the way. We do have some going on, but it does seem lighter. And I think you put your finger on it. You know, I think some of the banks that did it were the banks that were earlier in the process of taking a pause. I am really optimistic on that, though, Zach. You know, and on the supply question generally, I'm pretty optimistic. You know, banks are like the rest of us, and yeah, they pull back sometimes, but after the end of a quarter when net income didn't look that good, I mean, they need revenue just like any other business. And subscription finance does provide, you know, a pretty solid source of risk-adjusted revenue that can come in larger chunks. So I think natural tendencies are going to ultimately win out, and we'll start to have some of those banks really come back sooner rather than later. And we've actually started to see a little bit of that. So, you know, fingers crossed from my side. I'm pretty optimistic you'll see a number of the banks, you know, really come out and be part of the market again here soon.
Yeah, and we're starting to see that. Again, if we're referencing the Bippart article, you know, this is in April when it was pretty tough, you
That's
know,
right.
for new deals and new business. But yeah, I will say that I've been tremendously heartened by the banks that have remained active and how hard these bankers are working. I've never seen these men and women at banks work harder. You know, we had a closing last week that went well into the night, and the bankers were right there. It was great to see.
Yeah, that's good. That's good. So one thing that's changed a little bit for me from the start of COVID to now is the number of NAV facilities I'm talking about. You know, in April, I felt like I was getting 3 phone calls a day from people looking for a bank that would do an NAV deal, or from banks trying to do it and talking with credit about the risks and things like that. That slowed down a lot for me in June. And I thought it would have been really picking up, but it hasn't. You know, what are you seeing on the NAV front?
Well, as we know, and we've talked about over the years, this is a little bit of the Wild West of fund finance, right? I think we have not seen a dip. Look, we touch one very small part of the elephant, right? There's no doubt that you know, you and other folks see a lot more than we do. We do talk to quite a few sponsors, and I would say half of those 4 or 5 calls a week that we get from sponsors, my partner Richard and I are dealing with NAV requests. And there is, this kind of ties back into your earlier question regarding supply. I do think that there's a supply issue with respect to NAV financings, not necessarily for buyout funds, right? Those buyout funds have been being serviced by NAV providers for some time. The banks and the alternate credit providers kind of naturally flow to those funds just because their returns, and they can afford to borrow at higher rates. So the product just fits better with buyout funds. I do think since COVID, you're seeing private equity real estate, which as we know is a large part of our market, and private credit funds also seek NAV financing. Those are more challenged given the return levels that they have, and they're not able to borrow at higher rates. But I'd say even more so than that, the banks and alternative credit providers really don't have the personnel to underwrite those types of loans just because they haven't had to. There hasn't been that kind of demand. So what you see now are private equity funds that are, can find NAV loans, but private equity real estate funds and private credit funds who are in search of NAV loans, and these are good deals, right? The LTVs are low. And I just think that the banks and the alternative credit providers are too busy with the buyout funds, and that's what they know, and that's what they're accustomed to underwriting, that they haven't yet had time to focus on those. And I'm hoping that they can either staff up or make pivots to be able to underwrite those loans, because look, NAV lending is going to be increasing. I firmly believe, and I've been wrong a million times, Mike, but I think, we'll be on the phone 6 months talking about the pref equity and the NAV deals that we're doing, probably more so than subscription lines, given the lack of fundraising that we, not just we, research analysts anticipate, starting in Q4.
Yeah, so I agree. I mean, I've been long-term bullish on the growth of that market and still am, although it hasn't materialized historically in line with my predictions. So I need to be humble about saying that it's going to continue to grow in the future. But I sort of feel like I've got this working theory, Zach, that, funds are going to need to ESG up, right? Their portfolio companies are going to need to focus on things like the gender wage gap, on minimum wages, on lower leverage, on fewer layoffs. And the natural result of those things are going to be longer hold periods and slightly lower returns. But at the same time, you've got these massively underfunded pension investors that still need high returns. And the only way you can kind of, meet both is putting on a little extra leverage at the fund level. And so when you combine that with the fact that these PE funds are some of the best financial engineers in the world at using leverage to create value for the equity, I just think it's inevitable that we see a growth of NAV facilities. But maybe we got to take a 5-year view instead of a 5-month view, to kind of realize a good chunk of that growth.
It's an excellent point, and I hadn't thought about the ESG angle, but there's no doubt that funds right now want a prolonged life and are looking to squeeze in another deal or two or support portfolio companies. But that's actually a really interesting point that I wish I would have thought of. And I hope you're right, because NAV financings are in a lot of ways really interesting to work on.
Yeah, for sure. So what else, looking out for the second half of the year, any other forecasts or any things that worry you?
Other than my daughter's lack of socialization, I would say forecasts, they very quietly, there have been some very large secondaries funds that have been, established and formed. And there is quite a bit of money on the sidelines there ready to pounce. Those managers are just waiting for the right time. And I do think if, current funds don't start paying more distributions, there's going to be a lot of movement in that secondary space. Problem now is, as you know, nobody knows what to value those private equity funds. I'm speaking in the broader context. No one knows what to price those at.
We did see some trades for the first time in the last probably week or two of June. And it's the first secondary trading we've really seen across our portfolio since COVID. So I have no idea if that was like the tip of the iceberg or what, but we did see some.
Yeah, and pref equity, as kind of an alternative to NAV, I think that sponsors used to have a negative view of that. But I think if you look at the trade, in some ways, it makes a lot of sense, not just at a particular fund level, but at a fund sponsor level. There's some looser covenants there, and there's some alignment of interests. I think we'll see more of those. I worry about fundraising. I'm heartened to know, certainly defer to you on pure subscription lines, heartened to know that we think banks are going to be coming back into the market. I hope that there are banks that, take a harder look at some of these more concentrated portfolios, especially by, highly rated LPs. But overall, I'm encouraged and certainly excited that, our broader industry and the individuals in it have worked so hard to keep moving here. It got pretty scary there in April, at least from our perspective.
Yeah, for sure. Well, we're certainly cautiously optimistic, and I mentioned this in a note last week, but I feel like my bankers don't get much credit in their own institutions. Here we have a product that they've structured, over the last few years in the height of optimism, and they structured it sufficiently well that we don't have a single deal in workout despite a global pandemic. I mean, that is a testament to the quality of the structures they put together, as well of course, the liquidity management of the funds and the investors. But, we've had a pretty good run from a credit standpoint here.
And one other note, I'm on the outside looking in, but I'm sure you have a better idea. I also think that people underestimate the amount of business that's generated through subscription finance and fund finance generally at banks. We spend a lot of time with our clients connecting them with, if it's a private credit fund, the CLO desk at the bank to see what else they can do, the FX desk. And, I know that bankers are, very concerned about the broader relationship. I can just tell you from, again, our little part of the elephant that we touch, we spend a lot of time nurturing those relationships and connecting individuals at the bank with our sponsor clients to make sure that there is an entire broader relationship and revenue stream for those banks, so that when the time comes, they can kind of go to bat for the sponsor and make sure that, they can be there in terms of a balance sheet perspective for their needs.
Yeah, agreed. Well, listen, Zach, you and Rich have your fingerprints on a ton of the deals we're seeing in the market. Really happy, not surprised, but really happy for the success you guys have got going here with your startup. You're doing great. Thanks for joining us today, man. It's good to see you.
Hey, Mike, good to see you. Hope to see you in person soon. Thank you and the Cadwalader team. You guys do a great job.
Great. So next we have with us Whitney Namm Pollack, who's the Executive Director of Project Sunshine. Project Sunshine is a great nonprofit organization based in New York that helps children in the hospital. And the FFA is looking for opportunities to partner with the organization. Whitney, thanks a bunch for joining us.
Thanks for having me. It's great to be here.
You bet. I hope you're holding up okay with COVID.
I'm lucky to be where I am and lucky to have this important work to really ground me, but thanks for asking.
That's great. Well, we're thrilled to have you. Matt Skirby is a board member of your organization. He's been a longtime contributor to the Funds Finance Association, and he has suggested you guys as a partner for our organization. So it's great for our members to kind of get to hear from you a little bit today. So tell us a little bit about Project Sunshine, its mission, and what you guys are up to.
Sure. So we are a 20-year-old organization that provides play and activities to children in hospitals across the US and 4 other countries. And we do it through volunteers. So by connecting volunteers to children and families who are facing any medical challenge, the play and activities that they provide help distract and de-stress and help children get better and heal. And that's what we do.
Yeah, that's wonderful. So I have to imagine that COVID has been disruptive both on the needs side and on the organizational response side. Tell me a little bit about how it's impacted you all.
Yeah, so we have 19,000 volunteers who are connected to over 400 hospitals. But since COVID began, our volunteers cannot go into the hospital. It's not safe for them. It's not safe for the patients, and it's not safe for hospital workers. So we've had to really pivot. So, and of course, the need is stronger than ever. We have had to really reimagine how we deliver our services, because there are still hundreds of thousands of children who are being hospitalized each month. And the isolation that they feel, I mean, when you're a child in a hospital as a parent, or you might have, or your listeners might have memories of being a child themselves in a hospital, it's a lonely and scary experience most often. And it can be lonely and scary for the families that are going through it too. Well, because of the pandemic, the visitation rights have had to be adjusted, or the way hospitals welcome visitors has had to really be adjusted for many hospitals during the height of the pandemic. And now we're seeing some other states flare up, but in the New York region and the East Coast, you had to choose one consistent caregiver. And that's really hard on families. So I think that this, the pandemic has really highlighted the connection between health and family and humans and friends, and what it means to be connected together. And I think that so many of us who've been sheltering in place have really experienced what isolation feels like. And so you can only imagine what it's like to be a child in a hospital during this time.
If a child went into the hospital right now, it's only like one parent that would be allowed to go with the child, or how is that?
So the rules are changing as hospitals are getting more adjusted to living with COVID-19. But yes, at the height of the pandemic across the country, you had to choose one consistent caregiver. So for a lot of families, that meant choosing one parent, because hospitals, rightly so, wanted to limit the exposure of new folks coming into the environment. No siblings were allowed. Playrooms were closed. There's no interpatient socializing. So hospitals, especially children's hospitals, have a lot of attention focused on creating a social experience for children when they're there, because that's so important to growth. As we're seeing many of us who maybe don't have children facing chronic medical challenges, without schools, you're losing some socialization for children. So with that, but hospitals have had to restrict visitors and are still restricting visitors across the country.
Yeah. But I imagine that'd be, terrible for the child, but also, my God, being the parent that can't go to see your child in that circumstance would have to be a really awful scenario too.
Yeah, it's hard on families, it's hard on siblings, it's really hard on patients. So we've had to pivot. We've had to be able to really think of and reimagine, how do we deliver our services, and how do we connect our volunteers? Our volunteers, 19,000 of them, want to be giving back, and we have been providing an opportunity for them to engage in service. And so how do we do this when it might not be safe for the rest of this year? It might not be safe for even longer. We're not sure. But we know that play and activities really help children heal. So we are launching a new program called that we're calling Teleplay, where we are going to be bringing children and families, we're always inclusive of families and siblings in our activities, into a video conference, much like the one that you and I are on right now, for scheduled play activities and connections. And so that will be launching later this summer. And we're really excited to be able to engage volunteers and different patient communities and our 400 hospitals.
Yeah, well, that's terrific. So a number of the fund finance associations, member constituent firms like Blackstone and Apollo and MSD and others have been involved with you guys. Can you tell us a little bit about how that involvement works and what kind of things they're doing to contribute to your organization?
Yeah, so thousands of our volunteers are actually come from the corporate community. And we've had some great partners like the ones that you've just mentioned, and some other funds and great law firms partner with us. And so they will provide donations, and we provide engagement for their employees to provide some corporate social responsibility activities and volunteerism. So in the pre-COVID time, we would do this through big groups in conferences. I know at the conference that you all have that was going to be in 2021 in Miami, we were talking with you all about doing something. And so we would engage people in this team building and by making activity kits. So the activity kits are individualized packages that are designed to have therapeutic value and be fun for kids in hospitals. So We have 11 different kinds of them, and there are all sorts of activities for all sorts of different abilities and ages. And corporate volunteers would assemble them, and it's really fun to do. And you can sort of, and they would, at a conference, one could assemble thousands of them. Well, now there's a really big demand for these kits because you can't access playrooms, you can't join in shared games. So they're single use, which means you can just use them one time. They are, in plastic bags, so they're easy to sanitize, and they're given to a child, and they can do them by themselves. There's activity sheets around it and directions, and they're built by volunteers. So we're actually so there's a huge demand for them. There's we in the beginning of the virus in March, we measured there's a 1,000% increased demand, which sounds like a made up number, but it's not, for these activity kits. So we actually have an initiative to try to get to 200,000 delivered by the end of the year. And we're actually inviting, and companies like Blackstone and Apollo have joined us for this. We're inviting companies, instead of doing them in conference rooms, which obviously isn't safe anymore, but companies are doing them in their homes, in employees' homes. And so we will send a box of activities, of the materials for the activities, and families or individuals at home will spend time building them, and then they're sent directly to a hospital. So we've just been able to, sort of rethink and be creative on how we're trying to get our work done.
If somebody felt inspired listening to us today, how could they go about getting involved and contributing?
Sure. Well, they can volunteer. So we need volunteers. We've always, we have a great group, but we're growing, and we want to reach, more children. So definitely volunteering. And you can also, join us and have your company or your family do activity kits and build them at home, and then send them directly to a hospital. And we have a waiting list of hospitals for it. And then raising awareness is also something that we need. People are sort of forgetting that there's children who are being hospitalized right now. And some have been waiting for their surgeries and other procedures because from the March and April time. And so there are hundreds, as I mentioned before, there's hundreds of thousands of children who are going to be in and out of hospitals over the rest of the year. And it's definitely a different time than before. So raising awareness about that on social media, by following us on social media and promoting us, that really helps. And then, of course, by donating. We are a small but mighty nonprofit that, we have had to really adapt how we sustain ourselves. And I think that we're doing that. But of course, individual contributions always help. And you can find all of that at projectsunshine.org.
Excellent. Excellent. Well, listen, Whitney, thank you so much for joining us. I really hope that the Funds Finance Association can have our 2021 conference, and we can find a way to have a partnership where we can contribute to your organization. Great to have you, and keep up the good work.
Thanks, Mike. It's been great to be part of it.
Thanks for tuning in to this week's Fund Finance Friday Industry Conversations. Thanks a lot to our speakers for participating. We've got a good edition coming for you next week as well, so look forward to seeing you then. Thanks.
The material and information contained in the podcast is for general informational purposes only. Any use of the audio within this podcast without the express consent of Cadwalader is prohibited. Quotes from this podcast may not be used without the express permission of the speaker.